Module 4. How to invest. You know why to invest and where to invest. Now, let's learn how to evaluate investments. We'll cover 3 critical concepts. Returns, how to measure and compare them properly. Risk, understanding different types and how to manage them. And taxation, because what you keep matters more than what you earn. These tools will help you make smarter investment decisions. Let's start with understanding returns. There are different ways to measure returns, and using the wrong measure can mislead you. Simple return just tells you the percentage gain. If you invested 1 lakh and got back 1.5 lakhs, your simple return is 50%. But what if it took 5 years? ROI, return on investment, is the same as simple return, but for comparing investments over different time periods, we need CAGR, compound annual growth rate. CAGR tells you the equivalent annual return, accounting for compounding. It's the most accurate way to compare investments. Let me explain CAGR with an example. Say you invested 1 lakh rupees and after 3 years it became 1.5 lakhs. Your total return is 50%, but your CAGR is only about 14.5%. Why? Because the money grew each year gradually, compounding on itself. CAGR equals final value divided by initial value, raised to the power of 1 over years minus 1. Here's another example. Investment A doubled in 7 years. Investment B grew 150% in 10 years. Which is better? Investment A has a CAGR of about 10.4%. Investment B has a CAGR of about 9.6%. A is better. Always compare investments using CAGR. Now let's talk about risk. In investing, risk doesn't mean losing money. It means uncertainty. There are several types of risk. Market risk. The overall market might fall, taking your investments down with it. Liquidity risk. You might not be able to sell when you need to. Inflation risk. Your returns might not beat inflation, making you poorer in real terms. Credit risk. The borrower might default on bonds or FDs. Reinvestment risk. When your FD matures, rates might be lower. Interest rate risk. Bond prices fall when interest rates rise. Understanding these risks helps you prepare for them. How do you manage or mitigate risk? 4 powerful strategies. First, asset allocation. Don't put all your money in one asset class. Spread it across equity, debt, and gold based on your risk tolerance. Second, diversification within asset classes. If you're investing in stocks, don't put everything in one company or one sector. Use mutual funds or buy multiple stocks. Third, time diversification. Instead of investing a lump sum, use SIP, systematic investment plan. Invest a fixed amount every month. This averages out your buying price and reduces timing risk. Fourth, education. The more you learn, the better decisions you'll make. Taxation is crucial because what matters is your post-tax return. For equity, if you hold for less than 1 year, gains are taxed at 20%. This is short-term capital gains or STCG. If you hold for more than 1 year, gains above 1,25,000 are taxed at 12.5%. This is long-term capital gains or LTCG. For debt instruments like fixed deposits, interest is fully taxable as per your income slab. Could be 30% if you're in the highest bracket. This is why equity is more tax efficient for long-term wealth creation. Always consider post-tax returns when comparing investments. Module 4. Summary. Always use CAGR to compare investments fairly. Understand the different types of risk, and that risk isn't just about losing money, it's about uncertainty. Mitigate risk through asset allocation, diversification, SIPs, and education. Remember that taxation significantly impacts your real returns. Equity is more tax efficient for long-term investing. Always calculate your post-tax returns. These concepts will serve you throughout your investing journey. Now let's understand the Indian ecosystem where all this happens.